It's 11:30 p.m. The only light in the room is the ambient glow of a smartphone. A notification flashes across the screen. A mid-cap engineering company has reportedly secured a major unannounced clean energy contract. The stock chart looks like an unbroken staircase climbing into the green. Within 4 minutes, without opening a balance sheet or cash flow statement, a thumb hovers, and a buy order is queued for the morning open. If you are this investor, you probably think your financial journey officially begins tomorrow morning when the market bell rings and the trade executes. In reality, the silent gap between the stimulus of that notification and the response of your thumb is where the trade's integrity begins to fail. Long before the asset hits the ledger, the mental framework required to protect that capital is already being dismantled by the speed of the impulse. This visualization shows the stark reality of how much capital evaporates in these pre-trade moments. A comprehensive study by the Securities and Exchange Board of India reveals a massive, overwhelming block of retail losses in the equity derivative segment, $12.2 billion in a single year, with 84% of all individual participants ending the year in the red. Those staggering losses sit right next to a microscopic sliver of highly concentrated profitable accounts at the very top. Financial destruction follows the strategic architecture an investor brings to the screen. Modern digital ecosystems are designed to bypass the analytical brain, forcing participants to enter the arena with a broken framework that prioritizes speed over investigation. To understand exactly why we enter the market so compromised, we need to completely leave modern Wall Street. We have to look back thousands of years to the Mauryan Empire and the master statecraft of a strategist named Chanakya. Long before digital exchanges existed, Chanakya warned rulers about a fatal structural flaw he called Aparikshat-Karitvam. This translates to the act of launching an enterprise or marching an army into battle without conducting thorough, rigorous, multi-layered investigation beforehand. It is the exact same mental failure playing out when you open a brokerage app simply because a ticker symbol is trending in an online chat group. Equating an emotional surge of enthusiasm with an actual strategy guarantees that you surrender your sovereignty and your capital before the first arrow is ever released. Chanakya believed any strategic action must be rooted in 3 pillars. The first is desha, or the terrain. In personal finance, your terrain is the underlying fundamental reality and the structural valuation of the specific asset you are stepping into. Today, investors are constantly pulled onto completely blind terrain. Academic reviews show that a heavy reliance on opaque social seeds and financial influencers artificially inflates retail trading volume by up to 35%. This creates what behavioral economists call the disposition effect. When you trade on an unverified rumor, you are essentially wandering blind inside a mirrored maze. Because you lack transparent data, you inevitably sell your winning investments far too early to secure a quick hit of dopamine, while desperately holding on to your losing stocks to avoid the emotional pain of admitting a mistake. When you buy an asset without understanding its internal terrain, you strip away your own ability to logically decide when to hold or exit. You become a passive target, completely dependent on external market noise. The second pillar is kala, or structural timing. For a modern investor, mastering timing means understanding the broader macro liquidity cycle, rather than simply chasing headline index numbers that happen to be green. This structural pyramid visualizes the deep fragmentation hiding inside the current economy. Notice this massive top block labeled semiconductor and tech leaders. Market analysis from Coutts shows these hyperscalers are projected to deploy over $650 billion in AI capital expenditure, and their incredible weight is masking the reality of the thin layers beneath them. Recently, a tiny group of these tech companies accounted for 62% of all emerging market equity performance. This extreme concentration triggers an availability heuristic, a mental shortcut where retail investors look at the roaring success of a few giants and mistakenly assume the underlying corporate liquidity is healthy everywhere. Investors look at the top of the pyramid and falsely project that strength onto the entire battlefield. They end up buying mid-cap companies at absolute top of the cycle valuations, entirely unaware that the structural liquidity beneath them is severely strained. The final tiller is kosha, the internal treasury. In behavioral finance, guarding your treasury means establishing strict capital preservation rules and mastering your own emotional regulation. Charles Schwab's behavioral research reveals that our brains process financial choices through two entirely different discount rates. When a stock is rising, greed kicks off a cortisol and dopamine loop. Future gains suddenly feel completely immediate and certain, compelling you to over-allocate your capital at the absolute worst time. Conversely, when the market suddenly drops, the weight of a financial loss triggers intense avoidance. Investors refuse to look at their portfolios, or they execute catastrophic revenge trades, doubling down on a rapidly failing position to try and win back their money in a single session. If you do not write down your specific investment thesis, your target exit price, and a hard stop-loss threshold before you ever purchase a share, your logic will evaporate the second the screen turns red. Raw survival instinct takes over your treasury. Chanakya observed two opposing states of mind. Kautuhala is an impulsive, superficial curiosity driven purely by emotion. Vijnana is systematic, verified truth derived from objective parameters. A modern investor operating on chat group rumors is trapped in Kautuhala. To survive, you must operate from the fortress of Vijnana. You build that fortress through a pre-buy defense framework, a strict, rules-based analytical firewall that sits between the moment you receive a stock tip and the moment you execute an order. Rule 1 is the 48-hour cooling protocol. Never buy an asset the same day you discover it. Introducing a mandatory 2-day delay neutralizes the intense emotional urgency of FOMO. It gives your logical prefrontal cortex the time it needs to override your primitive limbic system. Rule 2 is the inverse thesis requirement. Before purchasing any stock, you must find the strongest bearish argument against your own position. You have to write down exactly why the company might fail. If you cannot clearly articulate how this company could lose money over the next 2 years, you do not understand the asset well enough to own it. Finally, Rule 3 is the capital allocation constraint. Never allow a single unhedged tactical equity position to exceed 5% of your total investable net worth. Correct position sizing is your ultimate shield. It ensures that even if your analysis is wrong, a simple strategic mistake never snowballs into a terminal financial disaster. Protect your capital by mastering your psychological impulses before you attempt to master the market. The ultimate battle for your wealth is fought in the quiet spaces of the human mind, and it's won by the depth of your prior investigation, never the speed of your execution.